The cycle that I saw was brought about by seeing three important forces that I hadn't seen in my lifetime before, but happened many times in history, which is why I needed to study that cycle over the last 500 years. First, when governments run out of money, they need more money than they can get. They print a lot of money, and it debases that money. We have had the largest debt increases and money creations, particularly in the leading world's reserve currency, the dollar, although that's been true in the euro and it's been true in the yen too. And that has a big effect. The second of those influences is really a political and social influence, which is the conflict between the left and the right, populism, often typically due to large wealth gaps and opportunity gaps, which exist in the United States now. And so you're seeing a conflict, you're seeing almost a civil war, because as you have populism consists of representatives who will fight rather than compromise, fight for their way of doing things. And so we have an ideological and economic differences that are also political differences that you could see every day reflected in the news. And you saw become in January 6th that the issue of losing. I think we're in a situation where we can have an election in which neither side accepts losing. And so we see that reflected all the time, such as the Supreme Court ruling on abortion. You see that type of conflict. That conflict, the measures, I like to measure things, is the greatest since 1900. And that also relates to the economic one I touched. And then the third, as far as the changing world order, is the relative decline of the United States and rise of China and other countries. India, for example, of course, has improved its position, many countries. So that when the New World Order began in 1945, world orders come after a war, and then the victors in that war determine how things should go. In 1945, when the United States won the war, it was the richest country in the world. It had 80% of the world's gold, and gold was money. And it had half the world economy, half of world GDP. And it had a monopoly on the military power. It was the dominant world power. And that's why we have the United Nations in New York, the IMF and the World Bank in Washington, D.C. And that relative positioning, there's been a decline in that relative positioning and the emergence, particularly of China, as a great power. And so there is a great power competition taking place. And traditionally, through history, that is resolved by conflicts. So we have 5 different kinds of wars that happen, and we're seeing them now: a trade war, a technology war, a geopolitical influence war, a capital war, and a military war possibilities. So that confluence produces these difficult periods. The last one was 1930 to 1945, and that's what we're in the midst of. So it's very important for me as a global macro investor to understand those, and that's why I did this study. It affects my positioning today. The most important thing is to not own debt assets which are subject to inflationary pressures. If you're buying an inflation indexed asset, that would be fine. They're inflation index bonds, but to not own assets which will lose their buying power because there's a lot of debt and has to be printed. The second is to create a diversified portfolio of assets, a well-balanced. If you diversify well and you look at the correlations between asset classes, you'll see that one thing goes up, another thing goes down. For example, during times of greater inflation, you see commodity prices, gold, real estate prices. You see those types of assets perform better at the expense of other assets. And also the stock market has parts of the stock market, these different stock markets, which are not primarily going to be hurt by investments. There's many that benefit by inflation. So to create a diversified portfolio, diversification is of paramount importance because it is the way that you can maintain a good return without as much risk. In other words, if you pick investments that have about the same expected return, but they're not correlated, and you put them together well, you can reduce up to 80% of your risk without reducing your return. So how to create good diversification is very important. That includes country diversification. All the currencies are now fiat currencies. The dollar, of course, is the leading world's reserve currency. They are related to each other. No country wants, in this environment of relative depression or relative lower prosperity, no country wants to see its currency go up too much. So the fiat currencies, there tends to be a fair amount of printing money and then a lowering of that. We are in a temporary period that I would say will probably last 6 to 12 months of a tightening in monetary policy, but that will be the correction in the trend. That tightness will produce weakness in markets, to be followed by weakness in the economy, to be followed by another round of easing. So I want to be clear, the printing of money and the large debt will have a correction as there is this tightening coming up, which will be probably over the next 6 to 12 months. You'll have that. So as a storehold of wealth, they won't bring interest rates during that tightening to a level that will compensate for inflation. So you'll still lose money to inflation, which means it's still better off in those inflation hedge assets. So when we look at the currencies, we're used to looking at them in relationship to each other, but they all have that issue. Then there are non-currency, non-fiat. Gold is an example of a non-fiat currency. And then, of course, we have digital currencies, which are newly developed, and that's a non-fiat currency. I think we've entered a period of time over the next several years where the world is going to be looking for what is an acceptable currency, and it's going to be confusing. And so these currencies will compete with each other. There'll be less attention to fiat currencies and more attention than to others, but still, of course, the dollar will be important. And then you will see the renminbi become a much more important currency. Gold, let me tell you about gold as a generalization. Gold has a return, normally it's low returning. It is a dead asset. It is a beautiful, limited supply, dead asset that is money, unlike, let's say, equities, in which there's constant invention and productivity. But it's very important to own at some times, and at other times, it's just going to be a dead asset. And those times are these times of a lot of debt and money creation, and times of conflict, times of wars. In wars, even allied countries don't want to lend to the other country because everybody's getting in debt, and so they'll be paid back with a depreciated currency if they win the war. So I believe that this environment that we're in is an environment which is good for gold, and therefore it should be a significant part of the portfolio, but not a dominant part of the portfolio. What that might mean is maybe 15% of the portfolio. That would be, quite a large allocation. Under today's circumstances, perhaps, as much as that. And then there should be other assets that diversify the portfolio. Cryptocurrencies been really amazing in that, let's take Bitcoin. And there are two types of cryptocurrencies, I'm sure, in which the quantity is contained as distinct from other types of coins in which there's a variability, such as stable coins or Ethereum. But anyway, amazing that they were programmed and have operated for, I think it's 11 years now, haven't been hacked and so on, and have been acquired. Still, there are issues with them. The total value of Bitcoin, for example, all that money, is less than the value of Microsoft. And so when you think of different storeholds of wealth, it's not very big. By the way, the gold market isn't very big either. It's about 5 times the size if you take out central bank reserves and jewelry. So they have issues. Transactions can be traced. So the privacy issue is an issue. So they can't be controlled. They can be shut down. They can be made illegal, which tends to happen during times when they may be threats to the alternative currency. I don't think they'll be held as central bank reserves for various reasons. There's a saying that gold is the only asset you can own that isn't somebody else's liability. In other words, you own it and you don't have to wait for a payment from somebody else. And I think that as the environment that we're in, there is a risk of political confiscation or other forms of confiscation. Gold does, a better job. But as I say, we're into this new environment. Is it something that you can carry with you and that you can transact almost anywhere in the world because somebody will buy it? It's equally acceptable in most places, ideally private. If you can find those things, it's a competitor, but I think in terms of its qualities, not as good a competitor. One of the most important indicators is the cost of an intelligent person, a cost of an educated person. That's a very good leading indicator. India stacks up very well in that regard. And its levels of indebtedness, which is another important indicator, is in comparison to other countries relatively good. These are two important indicators. The general level of education and infrastructure and internal conflict and so on are areas of greater concern. And so is the element of the bureaucracy. It's a country that probably will have the highest growth rate over the next 10 years. We project it to have the highest growth rate of any country over the next 10 years because of the advantages of that, those things that I mentioned. And then to the extent that there is improvements in those, which it looks like there are improvements underway, then India's outlook looks very good.